Japan's stock market hit an all-time high for the first time since 1989. How could they not hit a new high for 35 years? Why is it going up so much now? Is there more upside in Japanese stocks? And could China be the next Japan with a decades-long flat market of their own? These are the areas I'll take you through in today's video. It all started with a massive bubble in Japanese stocks and property in the 1980s, which can be summed up in these three charts. In 1989, the Japanese stock market made up almost half the value of all global stocks, which at the time was way more than the United States. By the end of 2023, Japan only made up 6% of the global stock market and was less than a tenth of the size of the US market. It wasn't just the stock market that was in a bubble. The property market got so crazy that at one point, the grounds of the Tokyo Imperial Palace were supposedly worth more than all of the real estate in California. By 2017, it was estimated to be worth about $12 billion. Not too shabby for 1.3 square miles, but only about 1/1000th of the value of the real estate in California. By the late 1980s, Japan was actually a wealthier country than the United States, but they pretty much stalled out for the last 30 years under the weight of an aging population, an army of zombie companies, and a mountain of debt. Things are changing though. The sun is rising over Japan, and there's good reason for the optimism that has rocketed Japanese stocks up over 50% since the beginning of 2023. Japan is going through three significant transformations right now. First, Japan finally has positive inflation after battling deflation for decades. For the past few years, most of the world has been like, oh no, inflation. But Japan has been like, okay, maybe a slight exaggeration, but positive inflation leads to rising wages, rising profits, and hopefully a shift in the ultra-conservative saving mindset that would lead to more investing. If that happens, Japan could be off to the races. The second big change has been corporate reforms. Japan has always had sort of a two-tiered stock market, with some big global industry leaders and some overly conservative, inefficient companies that were managed with all the excitement of a savings account. At one point in 2023, almost half of them were trading below book value, which is the value of their assets. That compared to only 5% of companies in the S&P 500. But then, the Tokyo Stock Exchange told them to get their act together. And now, a lot more are focused on improving profitability and raising their stock prices instead of just sitting on cash. The third big change in Japan has been the digital transformation. While Japanese companies were at the cutting edge of technology in the 1980s, a lot of them have fallen behind after decades of low investment, but now they're finally starting to catch up. So that begs the question, is there more upside in Japanese stocks? Yeah, I think there probably is. Even after the run-up in 2023, you can see from the red line that Japanese stocks are still not very expensive. Transformations like the one they're going through don't happen overnight, and there may well be some bumps in the road, but the changes I'm seeing are significant, positive, and I believe they could be long-lasting. The transformation is still fragile, and if there's a global recession or falling Japanese inflation, it might stall out, but I think there's a good chance we're only in the early stages of the turnaround. If they can sustain positive inflation, and that leads to rising wages this year, that will be a great sign that the mindset in Japan is really shifting, and that's a very powerful force. Then, if the US cuts interest rates in the next few years, that could raise the value of the yen and provide an extra boost to returns on Japanese investments, at least for US-based investors. I did a video a few months ago about why I was investing in the Japanese yen, and I still think it's attractive from here. Japan still has other challenges, like an aging population, but if this transformation is successful, it could set them up for many years of strong investment opportunities. The final area we'll cover is a comparison with China. There are some really striking similarities between China today and Japan in the early 90s. And China is at risk of following in their footsteps with a decades-long flat market of their own. In the 1980s, Japan dominated futuristic industries like cars and electronics. Now, China is the leading producer of electric vehicles, and they control many key parts of the supply chain for electronics. Where do you think the iPhone's made? People in Western countries like the US used to fear that Japan was going to become the next great economic power. Remember this gym from the 1980s? Now, it's China that's seen as a threat. The US also put massive tariffs on Japan in the 1980s to reduce the trade deficit. Sound familiar?
The United States has just announced tariffs on another $200 billion in Chinese-made goods, but I've made clear our trade imbalance is just not acceptable.
In Japan, people were getting so rich that they started buying up properties and businesses in the US. Decades later, China did the same thing. The 80s boom in Japan had a lot of similarities with the 2010s boom in China, and the bust looked pretty similar too. In Japan, it all started when the government put new policies in place to curb speculation in the real estate market. In China, it all started when the government put new policies in place to curb speculation in the real estate market. Both saw falling real estate prices, both saw many insolvent companies, both saw major stock corrections, and both struggled to fend off deflation. Now, here's where it gets even more interesting. One of the main reasons the Japanese economy struggled over the past 30 years is because of their aging population. From 1990 to 2020, the percentage of Japan's population over 65 more than doubled from about 13% to 30%. In China, it's projected to go from 13% to 32% over the next 30 years, almost exactly the same thing that happened in Japan. With a declining birth rate, immigration is the only way to get more young workers into the country, but China's immigration policies are actually even more strict than Japan's. Another key reason Japan stagnated was the massive army of insolvent zombie companies that weren't allowed to fail. There's a similar phenomenon in China right now with their property developers. Hundreds of them have defaulted on their debt in the last few years, and many property-related companies are insolvent. But China isn't letting them fail. Instead, they've been asking the banks, which are owned by the government, so it's not really asking, to extend the loans and reduce the interest rates for these failing companies. That makes the banks less profitable, ties up money that could be lent to other more productive companies, and keeps thousands of zombie companies around that can't do anything for years except slowly pay down their debt. If China keeps going down this path, they're at serious risk of following in Japan's footsteps. That means on and off deflation, slow economic growth, and many years until their market recovers. It took almost 35 years for the recovery in Japan. So far, it's only been 3 years for China. Could it really take over 30 more years for their stock market to recover? My guess is no, but Japan showed us that anything is possible. Let me know what you think in the comments. By the way, this channel is run by 2 experienced investment professionals. If you want to continue the conversation, we do have a free Discord. That link is below in the description. Thanks for watching, and if you want to see more on the Japanese yen, check out that video here.